Good morning. You're watching a live market outlook for Friday, 2nd of December 2011. The last day of the week and the first Friday of the month. Significant day today as we are going to see the release of U.S. jobs data, widely expected to come in some more positive tone as the recent indicators released from states are showing a slight but stable positive action, and looking for a stronger action in the picking up in the growth of U.S. economy. Markets are widely quiet, awaiting today's release. However, the positive tone on the 2 days ago central bank joint action is still existing, and the markets are still looking for some stronger push to resume the current action higher. Especially we're talking about euro and the commodities, as well as Dow Jones that is steadily going higher and looking for test of the previous high at 12,200. Some positive news from Eurozone came as yesterday's the new head of European Central Bank, Mario Draghi, signaled yesterday the central bank is ready to act more aggressively to fight Europe's debt crisis that is worsening in the past couple of weeks. If, of course, political leaders agree next week on their meeting on much tighter budget controls in the 17-nation Eurozone. The French President Nicolas Sarkozy called for a new treaty incorporating a tougher budget discipline, a European Monetary Fund to support countries in difficulty, and decision in the euro area taken by majority vote instead of unanimity. Addressing supporters in the city of Toulon, Sarkozy said he and the German Chancellor Angela Merkel would meet next Monday to outline joint proposals to put to a December 9th EU summit seen as a make or break for the 12 years old single currency. European Central Bank President Draghi painted actually the outlook picture of the state of Europe in dark colors in his yesterday's speech, as well as the European banking system, speaking a day after the world major central banks took emergency joint action to provide the cheaper dollar funding the starved European banks. He said that a new fiscal compact would be the most important signal from euro area governments for embarking on a path of comprehensive deepening of economic integration. It would also present a clear trajectory for the future evolution of the euro area, thus framing expectations. Draghi did not spell out what action the ECB might take, saying only a commitment by political leaders to stricter budget discipline and binding their economies more closely is definitely the most important element to start restoring credibility. Other elements might follow, but the sequencing matters. In the short term, the economists expect the central bank to relieve pressure on banks and an economy heading into recession by cutting interest rates next week and announcing longer-term cheap liquidity tenders with easier collateral rules. Markets are pricing in a 25 basis points cut to 1% on the European Central Bank's interest rate meeting on the December 8th. The Mario Draghi, who faces some of the toughest decisions in the currency's 12 years history, after just 1 month in the job, said the ECB was aware many European banks were in difficulty because of stress on sovereign bonds, tight interbank funding markets, and scarce collateral. Downside risk to the economic outlook have increased, he said, noting that the ECB mandate was to maintain price stability in both directions, a rare indication that the bank is concerned about deflation risks as well as inflation. From the United States, as mentioned earlier, U.S. employment growth is likely to show the picking up speed in November, but the pace is not expected to be quick enough to bring down the country's 9% jobless rate. The non-farm payrolls likely increased based on the polls for about 120,000 new jobs last month, which would outpace the last month. October's actually result at 80,000. The polls vary from 80 to 160,000, but majority of the analysts agree that 120,000 would be the most realistic forecast for today's release. However, the unemployment rate is not expected to change, and the forecast for today is again at 9%. The report is also unlikely to take much pressure off President Barack Obama, whose economic stewardship will face the judgment of voters next November. The outlook for the U.S. economy is also being threatened by Europe's ongoing financial crisis, and unless the jobs report is far off consensus, it is not seen as proving decisive for the Federal Reserve, which is weighing whether the recovery needs further monetary policy support. Also, many analysts think the relative strength of the report will, in keeping with the recent trend, be bolstered by upward revisions to the employment counts for September in October. So, as mentioned, for non-farm payrolls, the expectations for today are around 120,000. We have some forecasts from 120, 122 to 126, while unemployment is expected to stay, the unemployment rate is expected to stay unchanged at 9%. More from today's calendar already released is Swiss. Pardon, just Swiss retail sales yearly. We still don't have results. Retail sales yearly Swiss in October dropped by 0.2%, as expectation was plus 1.2%. Further to come at 9:30 is UK's construction PMI. Forecast for today is lower than previous release at 53.9, with consensus at 52.1. And at 10 o'clock GMT, Eurozone monthly PPI for November expected slightly to decrease by 0.2% compared to 0.3% previous release. From Canada, employment change is expected to show a positive path by gaining 18.1 thousand compared to draw of 54,000 in previous month, while Canadian unemployment rate is expected to stay unchanged at 7.3%. That would be from today's calendar. Now we're going to take a look on the markets and see the developments and movements in past 24 hours. As mentioned, the markets are steady and rather quiet, awaiting today's release of the NFP in America that is due at 13:30 GMT. The latest strong rally on joint central banks action has peaked on euro at 135.32, with subsequent pullback finding for now good support at 134.20. Just under the initial support at 134.40 and above our key near-term barrier at 134.00. That stays intact for now. Overnight action was limited on the downside by 134.50. However, the upside still stays intact, and the levels above 135 are still out of reach for now. The hourly outlook is gaining some momentum and looking ready for a fresh action higher. Clearance of 135.20, yesterday's high, to and 135.32, the high of 2 days ago, is expected to spark fresh action higher, and the end of this consolidation phase, and the next levels to watch are around the 136 zone, where also stands 61.8% Fibonacci retracement of 138.10 to 132.11, and the previous high of 18th of November at 136.14, break of which is expected to confirm the near-term base at 132.11 and signal some stronger action higher, with the 138 zone to come in focus. On the downside, the risk would be on loss of 134.20 and 134, where also stands the currently 4-hour 20-day simple moving average that is currently underpinning the action from the downside, and loss of this would signal possible end of this bull phase and the refocus levels at 133 zone. And of course they might be signaling also the lower top of the broader downtrend of euro dollar. However, a loss of trend line support that is currently at 133 and previous low at 132.58 is definitely to confirm, and the refocus levels on the downside, where we have the strong support at 132.11 low of 25th of November, and our key support at 131.45. Significant also to mention that formation of the head and shoulders pattern is on the weekly chart, where we can see shoulder, head and shoulder, with the neckline at 132 zone currently holding the downside, and this would be a good signal for fresh developments higher. However, the wider picture shows the downtrend still intact, as long as levels above 138, around 139 and 140.90, where the 200 days moving average stands, are capping the upside. This is on the longer term. The British pound is also steady in the sideways movements after 2 days ago strong rally, with the fresh low at 156.36, just above our just below our projected good support at 156.55, previous high of 29th of November, and holding steady above this level. However, the narrowing range is looking for a fresh direction, and likely, like the other instruments, are waiting today's US jobs data. The release would likely be, in case of being positive, would be supportive at this point. Actually, we are going to see when it's released, not to speculate much now. However, on the upside, 157, 157.50 is immediate barrier ahead of 157.77, above which to focus next strong resistance zone at 158.80, 159, which is the previous high of 18th of November and the low of 10th of November. This is actually the strong 158.80, 159.20 is the strong resistance area, as this is the floor of the previous mid-October consolidation range. On the downside, the loss of 156.50, 40 support zone, as well as 20 days moving average, would signal further easing of the recent strong rally, with the trend line at 155.80, below which would be near-term bearish, and refocus levels at 155.25 and then 155 as psychological support. Dollar yen holds near-term positive tone after dipping below significant supports at 77.60.50, going down to 77.28, where the support was found, and also briefly breaking below the main trend line support, trend line drawn from 76.56 low of 18th of November. Holding above the trend line keeps the near-term positive tone still in play, as the pair approaches our key upside near-term barrier at 78.00, with 77.87 seen so far. Also, we have the trend line from a recent top at 78.27, that is capping the upside at 78.00. Forming of near-term triangle is likely looking for a break either side to show the future direction. However, the short-term positive tone of 76.56 is still intact despite the brief break below the trend line, and the likely scenario would be attack at 78. Clear break here, and above 78.14 is to refocus 78.27, the recent high, and possible extension up to 78.44 and 79 ahead of the short-term high at 79.52. That was the peak after the intervention of the Bank of Japan. On the downside, as I mentioned, the initial support comes at 77.65, which is the trend line, and then series of supports. However, loss of 77.28 would weaken the near-term outlook, and look for test of 77.10 and key near-term support at 77.00. For now, the hourly studies are showing still positive, are holding still in positive territory, as fresh momentum is emerging above the center line, and MACD is still holding above the midline and attempting through the signal line higher, with the 20 days moving average supporting the recent price action. Dollar Swiss is also in the recovery mode after dipping through all significant near-term supports at 91.50, 91.00 and 90.80, finding support at 90.64 so far. This is the low of 30th of November. The downside pressure still exists as long as the trend line drawn of 93.28, 25 previous highs posted on 25th of November is intact, and currently it's capping at 92 zone. This is also the previous congestion zone, as shown on the daily chart, with the break above, on the 4 hour, with the break above this level to signal possible bottom, near-term bottom at 90.64, and look for an immediate test of 92.50, the high of 30th of November, and possible extension up towards 93.28, and resumption of the broader uptrend from historical low at 70.67. Risk, however, still remains on the loss of 90.64 and 90 as psychological barrier, as this might signal a double top seen on the daily chart, and a possible stronger reversal with the 89.50 coming next. However, the stretch down to 87 zone is not ruled out in case of loss of 90 and the 89.50 initial supports. Gold holds steady after the latest strong rally that bounced off strong support area at 1700 that kept the recent dips, and extending as far as high as 1754, the high seen yesterday. The hourly and 4 hour studies are holding the positive tone, with 20-day simple moving average currently at 1733, underpinning the recent advance. Also awaiting the release of the US jobs data today to give some more clear direction, but short-term outlook from 1666 low of 21st of November maintains positive tone, as the pair regained and broke above 61.8 Fibonacci retracement of the down move from 1800 down to 1666. Levels to watch on the upside in case of break higher 1770, 1780 and 1786 ahead of lower top at 1795, and then we have 1800, 1802 high of 8th of November. On the downside, the 1700 zone remains a key support, and only break here would turn the short-term outlook bearish and would signal possible revisit of lows at 1671 and 1666. Crude oil also holds recent gains as the dip from 103.35 high of 17th of November was contained by 200 days moving average, and the upside action is attempting currently to regain the previous high at 101.70 posted on 30th of November. The studies hold the positive structure, and the focus is still on the upside at 103.35, above which to extend the gains towards 104.70, 105, and possibly to revisit longer-term high at 114.80. This is the high of 2011 posted on 1st of May. On the downside, immediate support at 99, while loss of strong support zone at 95 would turn the short-term outlook bearish.